Welcome to the Investing Show, where we discuss the news that matters to investors and get ideas to help you make more of your money. I'm Simon Lambert of This Is Money, and joining us on today's show, we have a special guest, Charles Stanley's Chief Global Strategist, John Redwood. John, welcome to the show.
Thank you.
Also joining us in the studio, our regular guest, Mr. Richard Hunter of Wilson King Investment Management.
Hi, Simon.
Richard. John, we've had the first round of the French election. Marine Le Pen is through to the second round, but so too is Emmanuel Macron. Is that the result that could be considered the safest outcome of the first round?
Shock horror. The commentators and the pollsters have last got one right after a glittering series of mistakes. And even better from my point of view, Charles Stanley thought on this occasion the pollsters and the commentators were calling it right, and so we were with the consensus. And yes, I think the markets are very relieved, because the markets do not wish to have a Le Pen or Mélenchon victory, because either of those candidates wanted to upend the euro and fundamentally change France's relationship with the EU, which would have all sorts of knock-on effects to the single currency and to assets in the euro area. And it looks as if Mélenchon has gone, obviously, because he was knocked out on the first round, and it looks as if there will be a fairly easy victory for Monsieur Macron against Madame Le Pen in 2 weeks' time when we come to the second round. That's the result the markets want. It's not without its hazards, because of course then the markets will start saying to themselves, but how can Monsieur Macron be the President of France and have executive results? Because of course he doesn't have a party, and he may not have a lot of MPs in their parliament willing to do his bidding. So we were then going to have to live through the worry about the French Assembly elections in June, which will determine how much support Macron has for his programme. But overall, it's good news for European assets, and there was a relief rally underway today.
And do you think, in terms of before we go into the second round, do you think that Macron-Le Pen outcome is potentially considered by the markets and investors as a safer outcome than it would have been if it was Fillon, perhaps? Because then there would have been less to choose between the two candidates, whereas at least here you've got one person one side, one person the other.
I think the markets would have felt that either Fillon or Macron should be able to beat Le Pen quite easily, because that's what the polling is telling us. And as the polls were remarkably accurate for the very difficult thing to forecast between the four front-running candidates who were all around 20%, I think it gives the markets more confidence that when they're all saying that Le Pen is going to be beaten by 20 points, it would be pretty unlikely if that wasn't the result. And it was a very similar polling on Fillon as on Macron. The one they didn't want was Mélenchon against Le Pen, because then both candidates would have said, let's destroy the euro, let's completely change the European Union, and markets don't like that degree of uncertainty, and they'd have had to reprice the whole thing.
So Macron obviously represents something different in that, as you said, he doesn't really have a party. But does he represent real change for France, or does he represent continuity? And what does that mean for France and Europe as well?
Well, he's a very clever man who has run as the anti-establishment candidate, whereas he is, of course, the establishment candidate par excellence, and he will have the full French establishment supporting him. That's why most people think he's going to go on to win. He'll have the establishment parties, or most of their members and supporters, Les Républicains and the Socialist Party, saying back him. But then we don't know how good he will be, assuming he becomes president, at getting a majority and a prime minister that he can work with in the Assemblée. And his programme is pretty sketchy, because it's been cobbled together quite quickly, and I think deliberately sketchy, because if you're trying to attract votes from the right and from the left, you can't go into too much detail quite often, because you get into contradictions and you start upsetting people. So our view is that he's very likely to be the president, that not a lot will change, because it's going to take time to elect a new parliament and for the whole thing to settle down. And it will be quite difficult constructing majorities for the left and right of centre things he wants to do. We also have to ask how compatible they are, because he seems to both want to lower taxes and promote business for the right of centre agenda, and to spend more on social solidarity and benefits for the left of centre agenda. Is that possible? Do the sums add up? Does one contradict the other?
There seems to have been a number of American investors who are caught in two minds at the moment. They're seeing the recovery in Europe on the one hand, and certainly a better situation than we've been in since the financial crisis. On the other hand, they seem reluctant to dip their toe in the water because of the political uncertainty we've had. Obviously, we got through Netherlands, France, Germany and Italy to come, etc. If the French result had or does go exactly the wrong way. Was that really an existential crisis for the EU?
Well, I think it was a big crisis, and it's one that the markets wouldn't have taken kindly to. I mean, people who vote against the establishment have been delighted to overturn it. They think something better would result. But the short-term impact would have been markets saying, how do we price the euro, and therefore all shares and bonds in euros, if a major country like France is in danger of leaving the euro? And would that lead on to other countries wanting to leave, and would that break up the union? So the way I put it, trying to explain to investors a few months ago, was that the euro was on the ballot paper in the Netherlands, in France, and it could be on the ballot paper in Italy. And it's passed two of those very big tests, and we now know that the euro is safe in France, assuming Macron goes on to win the presidency. And it looks as if the Netherlands, only giving a minority of the seats to the anti-euro party, although they were top-placed party, is not going to do anything rash on the euro either. So I think people breathe a sigh of relief. And then I think you look at relative valuations, and you say, well, Europe's probably recovering a little bit faster in profit terms than America, because it's got rather more recovery to do and started after America. But America has great strengths as well. We like both. And I think on the margin, yes, there's something to be said for a little bit more European commitment, because a lot of people have reduced their European commitment because they were very nervous about the Le Pen challenge and the Wilders challenge in the Netherlands, and that looks as if it's going away. And they might then want to adjust their portfolios accordingly.
So would you, and again, something that US investors aren't too clear on at the moment, particularly when they look at their own banks, for example, and see the gulf between European and US banks, do you tend to favour a stock-specific bottom-up approach, or are you looking on a sort of sectoral basis within Europe, for example?
Well, Charles Stanley, we do both. I mean, I offer them advice on strategy, so I'm just trying to get sensible comments on which markets. But we have a capability at Charles Stanley to offer advice when we know people's circumstances on a share portfolio and or using trackers. I mean, trackers is a very simple and straightforward and relatively cheap way of doing it. So if you want to move money quickly into France and Germany or into the euro area as a whole, there are perfectly good tracker products available that can do that. Or if you want to go to specialists, then you need to ask about stock up. But and the call I'm making will give you much more return by getting the which market call right than it will about stock selection in a balanced portfolio. So I think that's the thing to concentrate on. Is it the right time to go into these markets?
Which of those markets in Europe do you think look the best at the moment? I mean, we've got the DAX in Germany hitting record highs again. Is it somewhere like Germany that you look at, or are you looking at that and saying, well, the valuation is high, well, you'd be better off going for the countries that are further down and they've got more room, more headroom to rise?
Well, I quite like a tracker that covers the whole thing, because the case is that euro risk has reduced, assuming Macron goes on to win the presidency. And so the whole area will benefit. And yes, Germany will be the leader. Germany is the economy that's recovered furthest and fastest, has the extraordinarily dominant position in the export markets, has a massive surplus, is closer to full employment, and has a bit more inflation now than some of the weaker countries on the periphery. But I think this is a tide which will help all boats, maybe with the exception of Greece, and that you'll see the recovery filtering through to the rest of the Eurozone as well, as it appears to be doing.
And do you, when you look at the euro itself, the currency, I think, you know, if ever there's been a currency that's suffered a few existential crises in the last few years, it's definitely the euro. Do you now, providing that that result that in the next round of the French election goes as expected, do you now see the euro managing to survive in its current format, you know, into the medium term?
Well, I've always thought it was going to survive for a few years that you can foresee. And I'm pleased that judgment seems to be vindicated by recent political events, subject to the final round of the French presidency election. Whether it makes old bones is still by no means clear. So I think there will always be a bit of a discount on the euro until they sort out one or two of the big strategic issues that still bedevil the currency. And the most obvious strategic issues are, will they start transferring enough grant money around the zone? Because usually to make a single currency zone work, where you've got big variations in income levels and employment levels around the zone, you need big transfers of free cash, and the rich parts are very reluctant to do that. And in the meantime, will they extend or improve on the current way they've got of transferring money around the zone, which is, of course, through the the balance is held at the European Central Bank, because what we've seen is Germany has built up the most colossal surplus, which has been deposited at the European Central Bank to reassure Germany, safe claim, safe bank. But that money has effectively been lent out to Greece, Italy, Spain and Portugal. And it might be quite difficult getting some of that money back from Greece. So they've got to put in place sensible arrangements for the Greek debt problem and, in due course, the Italian and Spanish and Portuguese debt issues to reassure people that they have a proper grown-up system. Because it's really a currency in search of a country to love it, is the way I put it. And so I think the dollar and the pound and the yen will always be better thought of than the euro for the time being, because you know exactly what you get with those. You know that you get the full weight of the US Treasury or the UK Treasury behind the banking system and behind the currency in a way that you don't get a guaranteed support for the euro.
No, I think investors look at the euro and bonds denominated in euros from different countries, and they think what I get is trouble.
Well, not all of them.
Not all of them, but I think that's what
but there is differential difficulties.
Potentially think that, yeah. We're going to skip over the UK because we've got an election on. We can't talk about that, and go over the Atlantic to the US. The dust has settled on the US election, if we can ever suggest that the dust has settled on President Trump.
I don't think a lot of dust settles on President Trump. No.
I was reading a post of yours that you'd written recently, in which you said it's now time that Trump has to deliver, basically, on the promises that he made. And you talked about something that you called Trumpism. What is it? Does he believe in it? Can he deliver? Can you tell us a little bit more about that?
Well, I think what the voters thought Trumpism was all about was reflation. They loved the idea of a bigger infrastructure program. He was never very clear whether it was going to be completely private sector money or a bit of public money, but they just knew he wanted to spend a lot more money on property and energy and new roads and better railway lines and all that kind of thing. That's what they want. And it was certainly about tax cuts. And he was very big on tax cuts, as are the Republicans generally, and he was talking about major cuts in income taxes across the board, taking the 7 current rates down to just 3 rates, and it would all be considerably lower, and much lower and better corporate taxes. And to try and make the sums add up, he said, but of course, I'm going to onshore all those profits that those huge American corporations have got resting abroad because they won't pay the current very high rate, so they leave the money somewhere else parked in a tax haven. So it all seemed to make sense. That's what people wanted. His problem, of course, is that the president's authority has to be expressed through the Senate and the House of Representatives. Now, good news from Mr. Trump's point of view is there is a Republican majority in both houses at the moment, and while that lasts, he'd be very wise to take advantage of it, because it would get a lot more difficult were the Republicans to lose seats to the Democrats in the midterm elections. Bad news is that it's clearly difficult getting all the Republicans, even in the House of Representatives, to agree on a package which they can get through. So we've just seen this wobble in the American market after this phenomenal run on the back of Trump's possible reflation, because Mr. Trump couldn't, with Speaker Ryan of the House of Representatives, deliver early the promised healthcare reform. Now, the healthcare reform was not as important, I think, to some Americans as tax reform, but the two go together. And they wanted savings from the healthcare reform in order to pay for the giveaways on the tax reform. So that's why they had to lead with the healthcare reforms, and they're still struggling to get those through. So Trumpism is on the line at the moment, and it will be vindicated, and people will start to get what they want if Speaker Ryan can get through some kind of healthcare reform, and or if he can get through a tax reform. Speaker Ryan was in London last week making a public statement, and he was very clear. He still thought he could get a healthcare reform through a little bit later than planned, but he also said if you can't get healthcare reform through, he was still up for doing some kind of tax reform.
Richard, we've spoken about whether President Trump can deliver on some of these things previously. And one of the things he is benefiting from, though, at the moment, is the US earnings reporting season. And it's a very busy time for that right now, isn't it? And things don't look too bad over there at the moment, do they, in terms of profits?
No, generally speaking, it's started off pretty well. We have, as you say, discussed in the past the fact that post his election to the president, the market has basically gone off on a tear. And more recently, perhaps stabilised a bit, just saying we've come this far. now it's time for you to start to deliver from your point of view. Even at these levels, with that pause for thought that US markets have had, they're on reasonably high valuations, not extraordinarily high, but reasonably high valuations. So the Q1 reporting season, which really is getting into fourth gear this week and next, an extraordinary amount of companies are reporting. It's extremely important, politics aside, that the US companies themselves start to kind of give their side of the bargain, say, well, this is actually what's happening on the ground. On Trump or no Trump, there were signs that the US economy was starting to strengthen in any event. But with the slightly lofty valuations, it's now extremely important that the companies themselves start to deliver and prove that that's what's actually happening on the ground.
Because with the market running out of a little bit of that early steam, if we suddenly started to see earnings disappointments and maybe some disappointing economic data, then big questions will start to be asked, won't they? You were positive on the US after Trump's election in terms of investing terms at Charles Stanley. Why was that, and what parts of the US are you particularly positive on?
Well, we were very positive for the two reasons. We first of all thought the markets would start to talk about reflation and tax cuts and more infrastructure spending would be a very good supercharger. But we also thought, as you just heard, that there was going to be an acceleration of earnings. The first quarter reporting season is well underway now, and it's vindicating that. A lot of different firms, including ourselves, thought there would be a reasonable increase in earnings of 10% or so. That is coming through. Any company that doesn't deliver does get very badly mauled by the market. So for people who can take the risk of shares, we like American shares as well as European shares. And whilst it's true that the ratings are a bit more expensive for American shares than they are for European or Japanese shares, I think there are a couple of mitigations. I mean, the first thing is that America has so much more technology in its population of quoted companies than most of the other countries and markets around the world. And I think technology is worth more because technology is where the phenomenal growth is occurring. We're seeing huge changes in what people want to buy and what they spend their money on, and a lot of the extra dollar or yen is going into technology products. So you've got a lot of growth coming through. And the other thing is that any market that has big oil companies and big banks is going to get a boost because both the oil and the bank sectors were very, very depressed with very poor rates of profit, in some cases loss from large corporations. And that is definitely improving this year, so that will benefit the American market as well.
And can you see that continuing for the rest of the Trump presidency? Do you think that looking at it in that sort of medium term, 4 to 5 year kind of time period, America can keep on that upward trajectory? Or do you expect there is going to be some form of slowdown over that period?
I wouldn't want to hazard a guess for 5 years, but I think the next couple of years look all right. And this year we, along with many others, expect world growth to be a bit faster, seems to be picking up a little bit of speed. Because it's synchronized. What's fascinating now is you've got America speeding up a little bit after quite a sustained period of growth. You've got Europe kicking in with a bit better growth, having been rather slow out of the big recession. Japan edging forwards, still fairly slow. But some of the emerging markets kicking in rather better this year as well with decent growth. So we think this year looks fine. That should extend well into next year. Ask me in a year's time, about 4 or 5 years.
Well, sorry, Tommy, there's also this philosophical navel-gazing going on in the US at the moment because of the strength in particular of their technology companies, whether the unemployment situation, notwithstanding they're getting near full employment in the States, is cyclical or actually it's structural. I think there's a similar kind of discussion going on elsewhere in the world, inevitably. But at some point that's going to have to be addressed because clearly it's most obvious in Europe, for example, in terms of youth unemployment at the moment. And maybe it's a longer term concern, but it does need to be addressed.
Well, I think we're going through a period of fantastic change. So I think there'll be many new jobs created as the American economy, the British economy and some others have been demonstrating. But yes, people have got to retrain or be flexible in order to take advantage of those because some of the traditional jobs are going. We've seen a massive demanning of factories in the advanced world over the last decade or so where automation has displaced very large numbers of people already. Some of that might now start to hit in services in other parts of the economy because we may find that computers are very smart and can do some of the jobs that administrators and executives did on service sector activities. So that's where there could be adverse pressures. But on the other hand, there'll be lots of new jobs in making the computers, designing the software, marketing the software, dealing with the new things that didn't used to happen. I mean, all those jobs in social media, there wasn't any social media 20 years ago.
As part of all that, I mean, that leads into what I was going to ask, actually, which is, I mean, how important in all of this is getting some of that money to the man and the woman on the street, who I think many of whom will look at that great change that's happened.
Yep.
They'll look at the change of the internet ages. They'll look at the amount of money that we're talking about in terms of corporate profits, the amount of money that people are being paid. And they say, well, I'm not getting any of this. How important is it to try and get some of that money to those people?
Well, I think that's a very important political issue, which is clearly dominant in elections in many advanced countries around the world. And there are different answers coming forward. And broadly, right of centre parties say we need to create more flexibility so that people can get into the jobs and keep more of the money they earn from the jobs by going with the market. Left of centre parties want rather more state intervention, say let's take more money off the successful people and give it direct in the form of benefits and grants to those who aren't doing well out of all this. And in practice, governments end up with a mixture of the two different styles. So some is done by redistribution through the state, and some is done by trying to promote benign change so that people can train and can get into the jobs where the opportunities exist. And where governments succeed broadly in doing that, they get re-elected, and if they don't, they get thrown out, as we've been seeing in recent years.
Almost out of time. Just before I wrap things up, there's one other part of the world I wanted to ask you about, which is obviously the part of the world where a lot of people see a lot of the excitement and the growth, but also a part of the world that is always subject to being sideswiped by what goes on in the developed economies. What are your thoughts on the emerging markets at the moment?
Well, we think they're picking up a bit as well. I mean, it looks as if the economies that had disasters in the last year or two, like Brazil and Russia, are improving a bit on the back of higher oil prices, better commodity prices, and some political and economic policy change, particularly within Brazil. Meanwhile, India and China seem to be growing pretty well. India has overtaken China as the fastest growing of those major emerging market economies now. She starts from a lower level in terms of income per head. She's now making a much better fist of it, and the Modi reforms are at last beginning to get into place and making a bit of difference. And we think China will be fine. China is the one that's subject to most fears and worries by investors. I don't know how many times I read the article which says that China's banks are about to explode and there's going to be a major crash and there's going to be a hard landing. We've been reading that for 3 or 4 years. Pleased to say it hasn't happened so far. I don't think it's about to happen. I think the Chinese authorities know about the weaknesses there are in their banking system and their local authority financing, and they owe the money to themselves. They don't have an external debt problem. It gets really difficult and painful for a country if, like a Latin American country, your debts are owed abroad because you can't devalue to get out of the way because you often owe the debts in a hard currency. It just makes it worse. Whereas if you owe the money to yourselves and you run your own central bank, you print your own money, in the end you print the money it needs to sort the debts out. And in China's case, they own both sides of the balance sheet, because the typical potential bad debt in China is money lent by a state-owned bank to a state-owned enterprise. So they've just got to get together and decide how they want to adjust the figures.
Just one of the, just as an aside really, one of the difficulties you can have, of course, whilst dealing abroad in the emerging markets, China in particular, is investing directly. And that's one of those occasions when, of course, you do need to look at trackers or funds covering the region, because it's so difficult for individuals to actually, to be able to invest themselves. And the other thing, I guess, is when are we going to stop calling China an emerging economy? I mean, it's second in the world at the moment. Probably within 10 years it will be number one. Perhaps that's the emerging part, that it's not quite number one yet.
When it's number
well,
one.
I think it's emerging because it's got so many people, so the incomes per head are still quite modest, and they've got a lot further to go on income per head. But when you've got 4 times as many people as America, obviously when you're as quarter as well off as they are, you have the same size economy as they do. So that's the sort of situation which is happening. But you're absolutely right. It is usually more risky to invest in the emerging market economies. You've got currency risk to bear in mind, as well as all the obvious political and economic risks out there. But these things can be managed if you take advice, or if you use a portfolio, just have a sensible amount in it, so that if it goes wrong short term, it's not the end of the world.
That's all we've got time for. John Redwood, thank you very much for joining us. Richard Hunter, thank you very much.
Pleasure.
And we'll all get back together again in the studio when China does become the world's largest economy, and we'll debate whether we can call it emerged. Thank you very much for watching. Goodbye.